Greece may find itself out of the limelight for a few months now that it has passed new austerity bills and secured some more financing from the original €110 billion EU IMF fund. Well, that keeps it out of the headlines until September, with any luck, when the EU, ECB and IMF, the Troika, re-examine Greek progress towards its deficit reduction goals. So, with Greece out of the picture temporarily, something else is likely to fill that news vacuum. And that something could be the negotiations on the US debt ceiling. The US breached its $14.3 trillion debt ceiling on May the 16th, and Democratic and Republican negotiators have until the 2nd of August to reach agreement on a medium-term deficit reduction plan before the US Treasury has to close government and possibly default on its Treasury debt. Well, if it does so, at stake is the US AAA sovereign credit rating. Market turmoil and a spike in Treasury yields is the likely result of default and downgrade. That said, with the ultimate payment of debt with interest on US debt not in serious doubt, just the timing, this is unlikely to be as catastrophic as a potential Greek default would have been. So, the next month will also shed some more light on the so-called soft patch, a period of slower growth, particularly in the manufacturing sector, that has been evident in global markets since March of this year. Part of the explanation for the soft patch is the supply disruption stemming from the Japanese earthquake and tsunami. If so, then as Japan works its way through this shock and supply disruptions ebb, we should begin to see activity data strengthen again, and with it, a return of market confidence. In other words, the soft patch will have been just that, not the start of something worse. In addition to boosting stocks, improving confidence could begin to change expectations for central bank policy. Although the ECB's tightening stance remains, with further hikes likely in Europe before the year end, the US Fed and UK Bank of England are not expected by markets to start their tightening cycle for a year or more. Improved activity and with it better market conditions are likely to see investors bringing forward their expectations for rate hikes from these other central banks, and in the process perhaps providing some support for the beleaguered dollar and pound. Well, that's it from eZonomics and me for another month. Bye bye.